Welcome back. Today we're looking at a summary of BigBear.ai's Q3 earnings, which covers a surprise profit beat, a big stock jump, and the Ask Sage acquisition. Let's dive in. Okay, so the piece leads with this shocking headline. BBAI reports $2.5 million in GAAP net income.
And the stock pops. Great news.
Right, but the reason for that profit, this huge $26 million non-cash gain, is kind of buried. So the presentation really needs to foreground the non-cash nature of that GAAP profit to manage expectations. The weakness here is that by delaying that crucial detail, it almost feels like a bait and switch. It makes you question the company's actual operational health.
But couldn't you argue you should lead with the big, splashy number? I mean, why dilute the good news right away? Let the reader figure it out.
I see that, but I think here it's about building trust. If the reader feels like they're waiting for the other shoe to drop, they're not really absorbing the rest of the analysis.
Okay, fair point. So the suggestion is to restructure it for immediate transparency.
Exactly. Get that context out there.
So an example would be, right after stating the $2.5 million in GAAP income, you immediately add a line like, this was significantly driven by a $26 million non-cash derivative gain.
Yes.
You're not hiding it, you're just contextualizing it. Then you can talk about the stock move and the backlog. It just flows better.
And speaking of that stock move, the summary attributes it to momentum. But I think there's a much bigger piece of the story that gets introduced way too late.
The Ask Sage acquisition?
The Ask Sage acquisition. It's a $250 million deal. This needs to be integrated earlier to really justify that stock surge.
I agree. The weakness is that the cause and effect feel disconnected. Was the market really that excited about a small earnings beat that was, mostly an accounting gain?
Probably not. It was the combination, right? The earnings plus this massive strategic play.
It has to be. So the suggestion is to position that acquisition as a co-catalyst for the market's reaction.
So how do you do that smoothly?
Well, instead of a whole separate section later on, you could just weave it in. Say something like, the market was fueled by the momentum of a concurrent announcement, and then boom, you hit them with the details.
The $250 million price tag, the 10x revenue multiple.
The FedRAMP High accreditation, all of it. That paints a much clearer picture of why investors were so bullish.
It does. Okay, last point. This brings us to the forward outlook. The piece mentions Cantor Fitzgerald's raised price target of $7.
Which implies a nice 20% upside.
But the one critical condition for that target to mean anything is, again, sort of tacked on at the very end. So our final point is this. The analyst caveat about Q4 cash flow has to frame the final assessment of that $7 price target.
It can't just be an afterthought.
Exactly. The weakness is that by mentioning it so briefly, it downplays its importance. Given what we just discussed about the Q3 profit being a non-cash gain, Q4 operating cash flow isn't just a metric to watch, it's everything.
It's the proof in the pudding, right? It shows whether the growth story is real and sustainable. So we need to elevate that point.
So the suggestion is to tie it directly to the analyst rating and make it the central action item for the reader.
For sure. You could even rephrase that final takeaway to be much punchier.
How so?
Something like, the key support level remains $6, but the longevity of this moderate buy thesis is hinged entirely on investors monitoring Q4 operating cash flow to substantiate the growth story beyond this derivative-fueled profit.
That's strong. It connects all the dots. So, to recap, we focused on three things. Foregrounding the non-cash gain for immediate transparency, integrating the Ask Sage deal as a key market catalyst, and then emphasizing that Q4 operating cash flow is the critical metric that validates that $7 price target.
Exactly. Making these changes will create a much stronger, more coherent investment summary. We invite you to make those adjustments and submit your work for